Hi, everyone, and welcome back to 1 Month in 1 Minute, a look back at trending events of the past month and what it means for your money. So, March was definitely a more volatile month, and you could really feel the shift in the market. And you probably heard the term risk off being used. All that really means is that investors started to pull money out of riskier investments like stocks and move towards safer areas like cash or bonds. In other words, it was less about chasing growth and more about protecting what they had. And a big reason for that shift came down to a mix of things: geopolitical tensions, rising oil prices, and renewed concern that inflation might stick around for longer than people were hoping. Now, if you zoom in a bit, the main storyline was really energy. As oil prices moved higher, the market started connecting the dots. Higher energy costs can feed into inflation, and if inflation stays elevated, that could keep pressure on interest rates. And that combination is what started to make investors more cautious as the month went on. By the time we got to late March, that caution really showed up in the markets. Selling picked up and big tech took the brunt of it. The Nasdaq slipped into correction territory, and we saw some sharp pullbacks in the S&P 500 and the Dow as well, so especially in that final week. Now, on the policy side, the Federal Reserve held rates steady at its March 18th meeting. And the message was basically this: we're watching both sides of this. The economy is still growing at a solid pace, but inflation hasn't completely gone away, so they're not ready to make any big moves just yet. We also saw a bit of a mixed picture in the labor market. Hiring looked a little softer earlier in the month, but at the same time, jobless claims stayed relatively low. So layoffs aren't spiking. It's more that hiring is just starting to cool off a bit. And then in the bond market, treasury yields moved higher as inflation expectations ticked up. The 10-year treasury got into the mid 4% range at certain points. And here's why that matters. Higher yields can put pressure on stock valuations, and they can also increase borrowing costs across the board. So when you step back and look at the month as a whole, March was really driven by headlines such as geopolitical risks, oil, inflation, and interest rates. And while months like this can really be uncomfortable, they're also a good reminder that a well-built plan is designed for exactly this kind of environment. Thanks for watching, and if you have questions about how any of this might impact your portfolio, your plan, or your next financial move, feel free to reach out. I'm always here to help. We'll see you in next month's recap.